You can get approved for a house you can't actually live with. That's the trap, because approval is a paperwork test. Affording the house is a life test. And if you've been scrolling listings late at night, you already feel it. The homes that look decent don't feel a little expensive. They feel impossible. Let me tell you a quick story. Erica is 29. She makes $95,000 a year. She's not reckless. She's not broke. She's the kind of person who says no to random spending. She's saved money. She pays her bills. She's trying to do everything right. Then one night she opens a home search app, and she sees the same pattern over and over. Anything livable is priced like it's a luxury product. Anything affordable looks like a long-term project. And here's the weird part. Everyone around her still acts like buying is normal. Her lender sounds confident. Her agent is upbeat. Her family keeps asking, "So when are you buying?" So Erica starts thinking the problem is her. Maybe she's behind. Maybe she didn't save enough. Maybe she should just stretch. But that's the moment I want to stop you. Because stretching is how people become house poor. And house poor is a special kind of stress. It's when you own a home on paper, but your life shrinks around the payment. You don't go out. You don't save. You don't breathe. And the scariest part? Nobody gets paid to warn you. The bank gets paid when the loan exists. The agent gets paid when you close. The seller gets paid when you buy. So today we're going to run a different kind of math. Not can you qualify, but can you sleep at night? This video is called What You Can Actually Afford, the Sleep at Night Home Formula. Here's the big idea. You don't buy a house with your salary. You buy it with what's left after life happens. After taxes, after groceries, after car stuff, after medical bills, after the random, of course, that broke moment. So we're going to use 3 tests: simple, brutal, and honest. Test 1, the after-tax test. If the payment only works before taxes, it doesn't work. Test 2, the savings test. If buying kills your investing and emergency fund, you can't afford it. Test 3, the bad month test. If one surprise expense forces debt, the house owns you. That's it, 3 tests. Now, why do we need this? Because the housing market and wages are not moving together. People hear a normal income and assume it buys a normal home. But in a lot of places, that connection is gone. Home prices jumped over the last few years, rates rose too, and that combination is a double hit. Price determines how big the loan is. Rate determines how painful the loan feels. That's how someone can make a decent income and still feel trapped. Not because they're lazy, because the math changed. And if you're thinking, okay, but I just want a starter home, I get it. The problem is, starter home is now a marketing word. It doesn't mean easy, it means smaller than the dream. And sometimes it still costs a fortune. So here's what we're going to do. We're going to start with the one number nobody wants to start with. Your maximum monthly housing cost. Not a house price, a monthly number. Because you don't pay for a house in one giant chunk. You pay for it every month, for a long time. And if the month doesn't work, the dream doesn't work. Most people do it backwards. They start with the listing price. Then they ask, can I make this work? And the process pressures them to say yes. We're going to do the opposite. We start with your life. Then we see what price fits. This is how you stop feeling crazy, because you're not failing the market. The market is failing the average person. Let's make this real with Erica. Erica brings home less than her salary suggests, because taxes exist, insurance exists, retirement contributions exist, life exists. So the first question isn't, what can Erica borrow? It's, what can Erica pay and still be okay? That's the difference between owning a home and surviving a home. Now, before we touch any mortgage calculator, we need to talk about the biggest lie in housing math. People say the mortgage is the payment. No, the mortgage is only the beginning. Owning a home is a stack of costs, and that stack grows over time. So when someone says your payment will be about $2,000 a month, your brain relaxes. Then reality hits with taxes, insurance, maintenance, HOA fees if you're unlucky, and sometimes mortgage insurance too. That's how a fine payment becomes a how are we still broke payment. And this is why people who look successful on the outside can be financially underwater on the inside. They're not stupid, they're just using the wrong definition of affordable. So in this series, we're going to build a filter that blocks out the noise, the hype, the pressure, and it leaves you with one clean answer: your safe monthly limit. Here's the promise. By the end of this video, you will know two things. 1. The maximum monthly housing cost that passes the sleep at night formula. 2. The rough home price range that matches that number. Not bank approved, not agent approved, you approved. And once you have that, the market gets simpler. You stop chasing fantasy listings. You stop getting emotionally attached to homes you can't afford. You stop playing a game designed to make you overpay. In the next part, we're going to build the full cost stack, step by step, and you're going to see exactly where most people get trapped. Let's build the number that actually matters. Not the house price, not the interest rate, not what a lender says you can handle. The number that matters is your true monthly housing cost, because that's the bill that shows up every month, and it doesn't care how excited you were on closing day. Most people only picture one piece of the puzzle. They picture the mortgage payment, principal, and interest, the part the calculator shows first. But homeownership isn't one payment, it's a stack, and that stack is where people get crushed. So imagine a whiteboard. We're drawing a tower. At the bottom, principal plus interest. That's the base. Then we add property taxes, then home insurance, then maintenance, then maybe HOA fees, then maybe PMI if you don't put enough down. And every time we add a layer, the tower gets heavier, not emotionally, financially. Here's why this matters. Banks don't approve you based on your life. They approve you based on your paperwork. They look at gross income, they look at reported debts, they run a ratio. Then they stamp approved. But the bank doesn't know your grocery bill. They don't know your health insurance premium. They don't know your car is one weird noise away from a repair shop visit. They also don't care. Their job is to make sure you can keep paying long enough that the loan is profitable. Your job is to make sure you can keep living. Those are not the same job. So we're going to do something most people never do. We're going to run affordability backwards. Instead of asking, what house price can I buy? We ask, what monthly cost can I carry while still building a good life? Now let's bring Erica back. Erica earns $95,000 a year. Sounds strong, but your salary is not your spending money. After taxes and depending on her state, benefits, and retirement contributions, Erica might take home roughly $5,000 to $6,000 a month. Let's be conservative and call it $5,800 monthly take-home. Not exact, just realistic. Now we run test 1, the after-tax test. Because if you can only afford a house on gross income, you're basically betting your life on a number you never actually touch. Okay, Erica takes home $5,800. Now we protect her future first. She wants to invest, even a simple goal, $500 a month into retirement, not extreme, just consistent. She also wants an emergency buffer, let's say $300 a month into a cash fund. That's $800 already. And that's good, because homeowners need cash. Stuff breaks. Now, basic life costs, groceries, utilities, gas, car insurance, phone, health stuff. Let's say her non-housing life costs are $2,100 a month. Again, not perfect, but normal. So far we have take home, $5,800. Retirement plus emergency, $800. Life costs $2,100. That leaves $2,900. That's Erica's maximum all-in housing number if she wants to pass the sleep at night formula. Notice what I said, all in, not mortgage, housing. Now let's build the cost stack and see what all in actually means. Say Erica is looking at a home where the principal plus interest payment is $2,100 a month. That's the number people fall in love with. $2,100. That's fine. They stop thinking. But we're not done. Add property taxes. In many places, that can easily be $300 to $700 per month. Let's use $450. Now we're at $2,550. Add home insurance. This is one of those costs people underestimate because it feels boring, but boring can be expensive. Let's say $280 a month. Now we're at $2,830. Still feeling okay, right? Here comes the part people pretend doesn't exist. Maintenance. Homes aren't subscriptions. You don't pay one fixed monthly price forever. Stuff wears out. Stuff leaks, stuff dies at the worst possible moment. A simple rule of thumb is to set aside about 1% of the home's value per year for repairs and maintenance. That's not fear-mongering, that's reality budgeting. On a $400,000 home, 1% is $4,000 a year. That's about $330 a month. Now we're at $3,160, and we haven't even added HOA or PMI. So here's the first shock number. Erica thought she was choosing a $2,100 payment, but the real, stable, all-in cost is closer to $3,100 a month. That is a completely different lifestyle. That's the difference between I can still save, travel, breathe, and I'm one bad month away from debt. And now watch what happens with our 3 tests. Erica's safe max housing number based on after-tax take-home was around $2,900, but the stack comes in at $3,160. She fails the formula. Not because she's irresponsible, because the tower is heavier than the number she has room for. And this is exactly how people become house poor. They choose a mortgage payment, but they accidentally buy a full stack. Then they spend years wondering why a good salary still feels tight. Now you might be thinking, okay, so the solution is simple. Just buy cheaper. Yes, but cheaper needs to be measured the right way. Not by listing price, by the all-in monthly stack that passes your tests. In the next part, we're going to do the reverse math properly. We'll start from Erica's safe monthly number. We'll translate that into a realistic home price range, and you're going to see why so many people feel stuck, because the math is not matching the narrative. Now we do the part that clears your head. We take your safe monthly number and we turn it into a real price range. This is where people stop arguing with feelings and start using math. Remember Erica. She takes home about $5,800 a month. She protects $800 for retirement and emergency cash. She has about $2,100 of normal life expenses. That left her around $2,900 per month for housing, all in, the full stack. Here's the mistake almost everyone makes. They see a home price first, then they force their monthly life to fit the payment. We're doing the reverse. We start with the monthly life. Then we discover the home price that fits. So how do we reverse it? We split housing into 2 buckets. Bucket A, the stuff that isn't your mortgage. Taxes, insurance, maintenance, HOA, and possibly mortgage insurance. Bucket B, the mortgage itself. Principal and interest. The reason this matters is simple. Bucket A doesn't care about your down payment. It's a monthly cost that shows up no matter what. So for Erica, let's make conservative estimates. Property taxes, $450 a month. Insurance, $280 a month. Maintenance, $330 a month. That's about $1,060 per month in non-mortgage housing costs. Now take Erica's safe all-in number, $2,900. $2,900 minus $1,060 leaves $1,840. That $1,840 is her safe ceiling for principal and interest. That's the mortgage payment she can carry, and still pass the sleep at night formula. Now we translate that payment into a loan amount. We don't need perfect math, we need close enough to protect your life. A simple rule at today's rates is this. At around 6% on a 30-year mortgage, every $100,000 you borrow costs about $600 a month in principal and interest. Not exact, but accurate enough for planning. So Erica can handle about $1,840 in principal and interest. $1,840 divided by 600 is just over 3. That means her loan amount is roughly $300,000. Pause and let that land. Erica makes $95,000 a year. She feels like she should be in the nice house category, but the math says her safe loan is around $300,000, not because she's failing, because she's refusing to become house poor. Now we add the down payment. If Erica can put 10% down, a $300,000 loan might buy a home around $330,000 to $340,000. If she can put 20% down, that same payment might stretch toward $370,000 to $380,000 because she could avoid mortgage insurance and reduce the loan size. So her safe price range isn't whatever looks good online, it's roughly mid-300s. Now here comes the painful part. In a lot of markets, the mid-300s doesn't buy what people think a normal home should be. And that's exactly why people get pressured to stretch. They see 450, 500, 600, and they think, if I don't stretch, I'll never buy. But stretching doesn't magically turn into comfort later. Stretching turns into fragility. Now let's do a second example, because this is where a lot of people get blindsided. Meet Marcus and Danny. They earn more than Erica. Combined, they make $130,000 a year. They think, we're fine. But they have two payments that look harmless until you do the reverse math. A car payment, $600 a month. Student loans, $300 a month. That's $900 a month in debt payments. Here's what that does. Those payments don't just reduce your cash flow, they steal your borrowing power, because every month your budget has less room for housing. And remember our rule, about $600 a month equals $100,000 borrowed. So Marcus and Danny's $900 a month in debt is roughly the same as losing $150,000 in mortgage capacity. And GAT point 6. That's not a moral judgment, that's math. They can still get approved. Banks will often approve a busy budget if the ratios barely pass. But approval doesn't run the bad month test. Now imagine Marcus and Danny buy at the top of what they qualify for. They move in, they furnish the place, they breathe for a month, then the bad month arrives. The car needs tires and brakes, the dog needs a vet visit, the water heater starts leaking. That's not an emergency, that's home ownership. And if their budget was already tight, what happens? Credit cards, balance transfers, just for now. That's how people turn a house into a debt machine. So let's make this practical. If you're watching this and you want a number, here it is. Your safe home price is not what you hope you can afford. It's what you can pay while still doing three things: saving, living, handling bad months without panic. That's the sleep at night formula. And if you run it honestly, one of two things will happen. Either you discover you can afford more than you thought because you've been disciplined, or you discover your dream price is a fantasy and you just saved yourself 10 years of stress. Now the next question is obvious. What if my safe price range buys a decent home in one city, but nothing in another? Exactly. Because housing isn't broken in one way, it's broken differently depending on your zip code. In the next part, we're going to talk about geography. Why the same $370,000 can be a comfortable house in one market and a tiny compromise in another. And then we'll hit the two silent escalators that most buyers ignore until it's too late: insurance and taxes. Now we talk about the part that makes this feel unfair. Because it is. The same money buys completely different lives depending on your zip code, and if you ignore that, you'll blame yourself for a math problem. Here's the simplest way to say it. There isn't one housing market in America. There are hundreds of micro-markets, and they play by different rules. In one city, a $370,000 budget is a solid starter home. In another, it's a small condo with fees. In another, it's a maybe if you drive 40 minutes situation. So when people argue online about housing, they talk past each other. One person is living in a normal market. Another person is living in a status market. And status markets are brutal because you're not competing against average buyers. You're competing against high incomes, dual incomes, and sometimes people paying cash. That's why advice like just buy a fixer doesn't land the same everywhere. A fixer in one place is a smart deal. A fixer in another place is still expensive, plus a renovation loan. So here's your first reality check. If your sleep at night number gives you a price range, and that range buys nothing decent where you live, that doesn't mean your formula is wrong. It means your location is expensive. And expensive locations don't respond to willpower, they respond to trade-offs. Trade-off number 1 is space. Trade-off number 2 is distance. Trade-off number 3 is time. Space means smaller home. Distance means longer commute. Time means you wait and build income or savings first. Those aren't fun options, but they're real options. Now let's talk about the two silent escalators. The costs that don't just exist, they grow. Insurance and property taxes. These are the bills that make people say, "Why did my payment go up? I have a fixed rate." Yes, your rate is fixed. Your total payment is not. Let's start with insurance. Most first-time buyers treat insurance like a checkbox. They grab a quote, They move on. But insurance is turning into a real budget problem in many places, especially in areas with storms, floods, fires, or hail. And even if you don't live in a high-risk area, costs can rise because rebuilding costs rise. Labor, materials, permits, everything. So your policy renews, and the premium jumps. Then your mortgage servicer updates your escrow, and your monthly payment increases. Not by $20, sometimes by a lot. Here's a quick mini story. Jason buys his first home. His mortgage payment looks fine. Year 1, his insurance is reasonable. Year 2, his renewal jumps. His escrow account comes up short, so the lender raises his monthly payment to cover it. Now, Jason's safe budget is suddenly not safe. And he didn't do anything wrong. He just didn't plan for the escalator. So how do you defend against insurance surprises? 3 simple moves. First, when you budget, don't use the cheapest quote. Use a slightly higher number as your baseline. Second, understand your deductible. A low premium can hide a huge deductible. That matters in a bad month. Third, check if you need extra coverage. Flood, wind, earthquake, depending on region. If you need it and you didn't budget it, your formula breaks. Now, taxes. Property taxes are like subscription fees you can't cancel, and they often rise over time, sometimes slowly, sometimes aggressively, especially when a home gets reassessed after sale. You buy a house at a higher price than the last owner paid. The county updates the value, your tax bill follows. And again, your payment rises through escrow. This is how people get blindsided. They think they're locking in a payment for 30 years. They're locking in a rate, and that's not the same thing. So when you run the sleep at night formula, you don't just need the current taxes and insurance. You need a buffer for them to grow. That buffer is not pessimism, it's adulthood. Now let's zoom out to the market question. A lot of people are waiting for a crash. They're hoping prices fall fast and everything resets. Could prices drop in some markets? Sure. But a nationwide everything becomes affordable crash? That's not something you should plan your life around. Why? Because supply is still limited in many places, and a lot of homeowners are sitting on older, lower rates. They don't want to sell and trade into a worse payment. That keeps inventory tighter than people expect. So what does that mean for you as a buyer? It means you may get more negotiating room than peak mania, more days on market, more seller credits, maybe rate buydowns. But it does not mean the world will hand you a dream deal. So the winning move is not wait for magic. The winning move is buy only if the formula passes. And if it doesn't pass, you don't force it. You adjust the levers. Lower the price target. Increase the down payment over time. Reduce other debt payments or change location. Those are the real levers. Everything else is coping. Now here's the biggest mindset shift. You're not trying to buy the most house you can get approved for. You're trying to buy the most life you can keep after the house. That's what sleep at night really means. In the next part, I'm going to give you a simple, practical plan. 7 steps. Not theory, a repeatable process you can use before you tour a single home. And if you do it, you'll stop wasting time on homes that would ruin your budget. You'll shop with confidence, and you'll know when to walk away. Now we turn this into a simple process you can actually use. Because knowledge that doesn't change behavior is just entertainment. And you're not here for entertainment. You're here because you don't want to make a 30-year mistake. So here are the 7 steps of the Sleep at Night home formula. Not perfect, not one size fits all, just honest. And if you do this before you fall in love with a house, you'll save yourself a lot of pain. Step 1. Choose your max housing number from take-home pay. This is the after-tax test. Open your bank app. Look at what actually hits your account each month. Not your salary on paper, your real take-home. Now pick a housing number that still leaves room for life. If you don't know where to start, start conservative. Aim for a number that lets you still save and still breathe. Step 2. Build the full cost stack before you shop. Don't shop with mortgage payment, shop with total housing cost. That means principal plus interest, taxes, insurance, maintenance, JOA if applicable, PMI if applicable. If you skip any of these, you're not budgeting, you're guessing. Step 3. Lock savings in the budget first. This is the savings test. Before the house, decide your retirement investing amount, your emergency fund amount. Even if it's small, it has to exist. Because a homeowner without cash is a homeowner in danger. If buying the house means I'll save later, you already know what later becomes. Later becomes never. Step 4. Run the bad month test on purpose. Pick a surprise bill, a real one. $1,000, car repair, medical bill, appliance dies. Ask yourself, if that happens next month, do I go into debt or do I pay it and move on? If the answer is debt, the house is too expensive. Because bad months are not rare. They're part of life. Step 5. Remove the payment killers before you buy. This is the part people hate because it's not glamorous. Car payments, revolving credit card balances, personal loans. These are the anchors that sink your housing budget. Here's the mindset. Every fixed payment you carry reduces what you can safely spend on a home. So if you want a house more than you want a nicer car, you know what to do. You don't need to be perfect. You need to be intentional. Step 6. Shop by monthly cost, not by listing price. This is where you become dangerous in a good way. You walk into the market with a number, and the number is non-negotiable. If the all-in cost doesn't fit your formula, you don't make it work. You walk. Because the truth is, the market will always offer you a bigger payment. That's not a sign you should take it. It's a sign the market doesn't care about your future. So when an agent says you can stretch, your answer is simple. I'm shopping with a monthly cap, not a dream. Step 7. If the formula fails, choose one of 4 real options. And this is where people feel emotional, because the options aren't always fun, but they are powerful. Option 1. Move. If you can do remote work, this is the cheat code. The same income can buy a completely different life in a different market. Option 2. Buy less house, smaller, older, longer commute, different neighborhood. Not because you're settling, because you're choosing stability over status. Option 3. House hack, duplex, roommates, rent a room, anything that turns housing into a shared cost. It's not glamorous, but it can turn a no into a yes safely. Option 4. Wait and build, save aggressively, increase income, reduce debt, strengthen your down payment. Waiting is not failure, waiting is strategy, because there is no trophy for buying too early and suffering. Now, let me give you a simple line to remember. A house is only a blessing if it makes your life better. If it makes your life smaller, it's not a dream. It's a cage. And the reason people get trapped is they confuse approval with affordability. Approval is easy, affordability is honest. So here's your closing reality check. If you run the sleep at night formula and the number says not yet, that's not you failing. That's you refusing to be manipulated by a process designed to maximize the loan. You're allowed to be the adult in the room. You're allowed to look at the math and decide you want peace more than you want a bigger house. Because here's what nobody tells you. The best home is the one that still lets you live. The one that lets you save. The one that lets you handle bad months. The one that doesn't make you panic every time your car makes a weird sound. That's what sleep at night really means. And if you take nothing else from this video, take this. Don't buy the maximum house the bank will approve. Buy the maximum house your life can support. Because your goal isn't to own a house. Your goal is to own your future.